Good morning, Mr. Dominic Mandato. Bright and early for you over there. I see the sun's coming up.
The sun is coming up, and it's a beautiful day in Calgary today. How are you, D?
It's coming. I am fantastic.
The sun is coming up.
Ladies and gentlemen, allow me to, Dominic, you have a lot, a lot to be grateful for. Thanksgiving's coming up next week. You got a lot to be grateful for. You just come back from a great trip. And I want to kind of talk about where real estate is going, what you've been thankful for in the last 3 to 4 years, because it's been a heck of a run for Invest Plus. And also, where do you think the market is going? It was, you and I have had conversations for many, many, many years now, and it was before COVID where you were talking about, and I remember the videos, and if people go back far enough in Facebook, they'll see the videos and on YouTube and stuff, and they'll see where you were talking about how industrial real estate was really going to blow up, how it was going to become the next big thing, how it was really a safe investment, and how it wasn't kind of governed by the same market conditions as residential real estate or other commercial real estate. And Dominic, you didn't know there's a pandemic coming, or did you? I don't think you did. But you made these claims and you made these calls based on your experience and based on your expertise. And I got to say, man, you were pretty much bang on, because industrial real estate really grew incredibly a lot since COVID and since the big boom of e-commerce. Also, given the tumultuous market we're in right now, it's also a super safe category of real estate, if you will, that hasn't been impacted like the other categories. Tell us a bit, kind of, Dominic, how you knew that was coming and kind of what experience you drew upon to know where you'd be today. Because that was 4 years ago, and here we are in 2022. We started having this conversation in 2018, 2019. It's pretty incredible you knew this was coming.
Well, you know what? I'm going to start with your first question, and first and foremost, I'm thankful for the team that we have here at Invest Plus. I mean, we couldn't be where we are without the strategy and the talent that we brought on over the last couple of years, and so that's been a big part. I would say thanks to Remy, and Remy also helped us a lot in terms of the marketing side and helped us be out there on the social media. And so thank you for that, JG, you and Bonnie. But in terms of real estate and in terms of industrial, the funny thing is I don't know if I've ever mentioned this before, but the first time I was told to get into, to get into industrial was around 2012. So that's how early, talking to a couple of realtors says, you know what, Dominic, I know you're in multifamily, but you should start looking at industrial. And that's how early, the seed was planted. But really it wasn't until 2017 when we started to look at that space. And what drove that was really yield. And yield for us is basically cap rates or cash flow that these buildings can produce, so that we can pay out consistently a distribution to our unit holders. And so for the last seven or almost 8 years now, we've been paying over 6% distributions to our unit holders. And if you're from Alberta, or even Saskatchewan, you would know that, especially between 2015 and 2020, things haven't been too rosy in this market, but we still were able to pay out those distributions. And in large part was because of the cash flow that these buildings provided. Now, when you couple that with what's taking place in the industrial market, a big part of that is, of course, this trend in e-commerce, which has been putting a lot of pressure on industrial space. The one thing that we forget too is the legalization of marijuana. And a lot of companies taking old and older buildings, maybe even new buildings, and growing marijuana in some of these cannabis indoors. So you have multiple crops, and that was for a short period of time also putting pressure on the market as well. Long term, though, the market is still very, very good, primarily because the demand is there. But the unfortunate or fortunate, whichever way you want to look at it, the municipality, the municipal governments, the provincial governments are very slow in releasing land. Anytime you try to get the city to release land for development, it takes a long time. There's a lot of red tape. And so you've got this demand, and the cities are slowly release that land. And that drives up the value of the real estate, and in this case, industrial space.
And that's why you say fortunately, unfortunately, because it's unfortunate for the space, but it's fortunate for Invest Plus, who's already in the space.
Exactly. So for those who are already in, you're already, you're riding this wave. For those who need the space, well, now you're having to pay the higher rates, the higher costs, and things like that. I mean, no one could have predicted, of course, COVID and all that, but we just looked strictly at the fundamentals, and we've gone through that process. We continue to do that today, and we still think that it's strong for industrial.
Now, there's kind of, if I break down our conversations over the last 3 years, Dominic, and I want to talk about the future of where you see this heading. So, but I want to connect it to the past, because you made three great calls. Number one was the how Alberta and the Western provinces were really poised for growth. And I got to say, you were saying this at a point in time when, like you said, the Western provinces were in the doghouse. I mean, we're talking 2018, 2019, early 2020. We were not seeing great return on investments in Alberta. And in fact, a lot of capital was flowing out of Alberta. And you were saying, listen, it's time to put capital into Alberta. Given that was one of your great calls, and now you've seen what happened to Alberta and the Western provinces over the last 2 years, 2 years since COVID. My question is number one, where do you see it going forward now, Dominic? Where do you think the Western provinces are now in their cycle? Because there's a lot going on for the Western provinces: food, fuel, fertilizer. Where do you think we are right now, and where are we heading specifically into 2023 and beyond?
That's always a bit of a a risky prediction, because we don't know what governments have played much more of a factor in the direction of where the economy heads, especially for here out of Western Canada. But given where we are with energy needs, given where we are with the direction of climate change and things like that, that's really driven people's decisions on, finding alternative ways to create energy and things like that. The trouble is that you can't make that change overnight. It takes time. And the reality is, it's actually the energy companies out west, that I believe are going to help us move into that direction, because they're going to have the cash flow to be able to do that. Fossil fuels are still a very affordable energy source. And in order for us to move to the new, the alternatives, there's going to have to be a transition. But that aside, one of the things that Western Canada, and I'm going to talk about primarily Alberta and Saskatchewan, that's primarily where we're in. We're also in BC, but if we really look at the economies of both of those provinces, you've got uranium, you've got mining, you've got agriculture, you've got tech, you've got a lot of other industries there that has been, has quietly been growing. You couple that with, now you've got major cities. So let's talk about the three major cities. You've got Vancouver, Toronto, and Montreal. And I'll just talk about really Toronto and Vancouver. And you've seen over what low interest rates have done to those markets. You've really seen an inflationary point where where real estate has become just unattainable for the average person. And so, whereas we haven't experienced that nearly as much. Mm-hmm. And so what we've seen, and then it's funny, because I was talking to some people out east about the buildings that we were buying at 7, 8, 9% cap rates. And they're saying, how are you achieving those cap rates? Well, the values just haven't climbed, the rents have. And as a result, our cap rates were higher. And so we're buying buildings at 7, 8, and in some cases even 9% cap rates, and locking in interest rates for 5 years or 10 years at 3.5% to 4%. And so, given where interest rates are now, it really positioned us well to even maybe ride out this inflationary times where we're seeing interest rates climb.
So you're still bullish on the Western provinces for the next several years, it sounds like. And it sounds like also the environment, specifically interest rates, which I want to talk about next, are helping in that direction. Where do interest rates have been? I mean, I don't remember a time when there was a hotter topic than interest rates, because right now it seems to be, what everyone is talking about, what the Fed is doing, what the Bank of Canada is doing, and what interest rates are happening. And I find this interesting, Dominic, because for some investors, interest rates in terms of what's happening at the Bank of Canada is having a real impact on them, especially those that are trying to get into the market, especially those that are going for variable rate mortgages. But there are lots of investors that, are talking about interest rates, but quite frankly, it doesn't affect them because these deals have been locked in either before at very low rates. Can you tell us kind of what you guys are doing, how it's impacting you, and where you see these interest rates going?
Well, as you know, we've had a pretty big trajectory in the last 2 years with acquisitions, and we were buying right in the middle of COVID as well. And for a lot of us in the real estate space, took the opportunity to refinance, even early refinance some of our properties because of the interest rate environment that was in there. So, those mortgages are locked in for 5 years. So 2020, you extrapolate that out to 5 years, it's 2025. So a lot of our mortgages don't come up until 2024, 2025. So we're in a very, very good position. We have, I think, one building that's coming up this year, but it's actually a building that was slated that we're looking to divest anyways. We're looking to sell. So it's on a short-term, variable rate. But that said, the rest of our portfolio is locked in, and we're talking half of where the interest rates are today. So when I look at we have we have BNN up on the screen most of the day here in our office, and and I look at a lot of these public REITs that are out there that are getting hammered as interest rates increase, as the market decreases. And the reality is that those REITs, they've locked in a lot of those interest rates early on. If they've acquired anything in the last 3 months or 4 months, it'll have a small impact on the entire portfolio, because the majority of them would have locked in a lot of those rates long term at a much lower rate than what it is today.
Well, it's interesting that you say that, Don, because one of the things I notice is a lot of investors are, given the environment, given the tumultuous market where some residential real estate's really on its, as being values are dropping, rents are holding strong in a lot of places across the country. Interest rates are up. So even though values are dropping, interest rates are up. So your overall debt service is the same. But I do find it a very good time where people are saying, listen, maybe I should get involved in a REIT. Maybe I should diversify my risk here and get into a REIT, because getting into industrial spread across a huge portfolio that's not nearly as affected by individual interest rate decisions that the Bank of Canada makes sounds like a really good idea at this time, doesn't it? I mean, what's your thoughts on that?
Yeah, absolutely. Right. We're being fairly selective right now with acquisitions, because the spread between the cap rates and interest rates is of course is tightened quite a bit. Sellers' expectation of selling their property right now is they're perhaps coming around for those who have to sell. Well, they're in a much more difficult position. For those who are considering selling, either are deciding to put that on the shelf and decide maybe selling later, or potentially having to readjust their pricing because the cap rates are just not there, or the spread just isn't there. So for someone who's looking to diversify their portfolio, the beauty about REITs is that it does provide you diversification. And when we're talking about diversification into real estate. You have multiple buildings under one roof, you have geographical diversification, perhaps even asset diversification, industrial, multifamily, retail, all of those things. So there's many REITs out there that have lots of options similar to that. We still have a little bit of multifamily, but primarily our focus has been industrial, and we're right from BC to Saskatchewan. So our from a diversification, but still focused in real estate. That's one of the things that REITs provide. there's a lot of rules around REITs in which we have to have a board. We have to pay out 90% of the free cash flow that the company produces. There's all of these rules that are in place to help protect the investor as well. That's in the interest of investors too. So there's a lot of advantages from that standpoint. Nothing is guaranteed, of course. There's always risks with all sorts of investment. You have to do your own due diligence. But at the end of the day, the REITs have performed very well, especially in the last 20 to 30 years.
I want to end by talking about protection. You said the word protection, and one of the calls you made, and one of the things we talked about many times on various videos and podcasts and things you and I have appeared on was how industrial, and specifically Invest Plus, was very well positioned to weather a storm. And we were talking about this, Dom, at the height of the frothiness of like the market in general. I'm talking about 8 months ago, 12 months ago, when it seemed there was no end to the prices of real estate and it was just going to go up forever. And now we've had this kind of market, let's call it market correction, let's call it softening, let's call it whatever you want to call it. But the point is that, I think Invest Plus in the industrial sector hasn't experienced the kind of correction that a lot of the other sectors have experienced. Maybe you have numbers that you can put behind this, but I know anecdotally, there's no doubt that industrial has been much more stable and safe and strong compared to like residential real estate, for example, where you may have bought something for 900,000 and now it's worth 700,000. I think investors are feeling that. What's been your experience of that in terms of safety, stability, and strength and protection?
Well, the biggest thing when you look at, it's not like I made the call or made the right call. At the end of the day, we just look at the numbers. The numbers just don't lie. Back in 2007, this market, especially in Calgary, was experiencing just a huge upswing. And there was a realtor who had reminded me that at the end of the day, it comes down to the numbers. It'll always come down to what's the rental income for that property, because at some point the value is going to come down to that. And so we're always factoring those things into our numbers. Then we're also acquiring in markets and in times of perhaps uncertainty. This could very well be that. In fact, right now we're positioned we're positioning ourselves to have a little bit of dry powder, a little bit of cash, because there might be some opportunities there. And that, I believe, is the key, right? We find ourselves sometimes, it's just human nature, people talking about, oh, look how great I've done on my piece of real estate. And now, and people are just emotionally driven to, I got to get in. They feel a little bit of FOMO. They feel like they got to get out there and get into the market, rush into the market, only to find out that they bought at the top of the cycle. Whereas our approach has always been, when I look back in terms of where most of our acquisitions have been, has been between 2003 and 2006, 2009 and 2015, and 2019 to about last year. And so even during COVID, when we had a building under contract and, WHO declares a worldwide pandemic, I'm thinking to myself, okay, what do we do here? And it's, but to us, it made a lot of sense to continue. What we recognized is we need a tenant that can assure us that they're going to pay their rent. And that building happened to have the government as our tenant. And so we thought, geez, who better than this kind of asset right now? So we were able to capitalize that. So when we're buying those buildings, to give you a few numbers, we're seeing anywhere from 8 to about 12% increases in our real estate in terms of value. Some higher than others because we were able to create some value there, where we bought the building empty and we put in a tenant, and some we just acquired the building as is, but as cap rates depressed, the values of the property went up. So somewhere between 8 to 12% is what we're seeing year over year in terms of increases. We're probably going to see that level off a little bit this year because of interest rates. But there's talk about us going back into a recession in about 12 months from now. I'm not terribly disappointed in that. I probably would offer some opportunities for us, but recessions are never a popular topic. But from our standpoint, that's where we thrive.
Yeah, awesome. Well, Dom, thanks so much for taking the time today. I think it's always great to get the thoughts and your expertise of where this market is going. And I tell you, if people were paying close attention 2, 3, 4 years ago, and we were having these conversations, you made a lot of very, very wise decisions, and you were able to forecast where the market was going. And I think that this kind of series we're doing is a bit of where the market's going next, because there is so much angst in the market and anxiety in the market right now for investors. And it's always so great to get the expertise of someone like you. So Dominic, thank you so much for doing this.
Hey, JG, always a pleasure. Thanks for having me.